All right, team. Good morning. Happy Wednesday from your favorite local mortgage broker here in Las Vegas and Henderson. It's Mario, owner of Sienna Mortgage here, and this is going to be a fun one. I'm actually quite confident that this conversation that we have today, when we discuss and talk a little bit about these new 15-year mortgages that are being all the talk in the news this last few days since Bill Pulte of FHFA said that he and Mr. Trump, President Trump, of course, trying to roll out a solution for affordability here in our real estate environment. So we're going to talk a little bit about the 50-year mortgages that are being proposed. Obviously, remember, guys, there is no such thing as a 50-year mortgage yet. We're going to talk all about the nuance of what a 50-year mortgage might look like, some of the pros, some of the cons, all of the above. We're going to go into some pretty heavy detail. Also, I've noticed there's been a lot of talk about another conversation piece that, again, in our industry, in the real estate world, especially these last few years when everyone's talking about real estate and affordability and housing, how expensive things have become, interest rates, like it's a lot, guys. It's one of the reasons when you are considering home ownership or you are a homeowner and you're looking to upgrade, downgrade, if you're looking to do anything house, real estate, finance related, you need to make sure that you're working with an expert and someone that's going to educate you and guide you through these crazy, crazy times and murky waters, because there's roadblocks. There's things that, you know what I mean? Like you don't want to run into these walls. You don't want to run into these, time wasters, if you will. And you want to make sure that you're set up for success. So again, who you partner with matters. Sienna Mortgage, of course, stands for where partnership matters. Make sure you guys are working with experts. But without further ado, let's get started. I want to talk first about the 50-year mortgage. Excuse me, give me just one sec. My little puppy here is not happy that the landscapers are here. So let me let her out of the room real quick. Hold on one second. Wait. Rosie, come with Daddy. Come here, Mama. Come on, baby. Okay, go play. All right, guys, and we are back. So let's dig in. Let's start this conversation about the 50-year mortgage. Let's bring up some bullet points first, as much fact as possible. And then we'll talk a little bit about the idea behind it, some of the theory, some of the math, some of the variables that'll come into play anytime you're talking about a longer term mortgage loan. I feel like just, obviously with the news, it's a little bit tough to dissect and interpret when you are not in and around the mortgage and real estate industry every single day. Okay. So first, when we see news articles being shared across large, obviously, legacy media platforms, and they're already talking about the implementation of a 50-year mortgage, okay, which presently, just so you guys understand right now, okay, in our present world that we live in mortgage and real estate finance, okay, we have some rules and regulations in place through something called the Dodd-Frank Act. Okay, the Dodd-Frank Act was established in 2010, and it basically structured for us in the mortgage industry, mortgage lenders, mortgage brokers, mortgage everything, okay, what is called a QM mortgage, qualified mortgage, okay? So you have, with a qualified mortgage, these government-sponsored enterprises, Fannie Mae and Freddie Mac, that essentially say as long as these mortgage loans meet these specific criterias, okay, they'll be secured and backed by Fannie Mae and Freddie Mac. So some of those criteria, just to give you an example, of course, are one of the things that we'll talk a little bit more about here at the tail end of the stream, which is qualifying FICO scores, maximum loan terms, right? So presently right now in a QM, a qualified mortgage, you cannot have longer than a 30-year mortgage, okay? So you would actually have to see, in order for there to become a 50-year mortgage that is backed by Fannie Mae and Freddie Mac, these government-sponsored enterprises, right? You would need some actual reform in some of these laws, okay, which obviously, as you guys can imagine, I'm sure takes time. So with a lot of these things, just remember, we're not talking about unless something absolutely dramatic happens, right? We're not talking about like immediate changes happening in the mortgage and real estate industry anyways. But with Dodd-Frank, again, you have to meet these certain criteria. Another one of them is like you cannot no longer have balloon payments on government's on a QM mortgage. You have to meet certain, again, qualifying criteria that's defined as what, again, we call QM, okay? So to be honest with you, there actually are loans presently right now that are in the non-QM space, okay, which would be what's considered portfolio lending, okay, where, again, that mortgage lender that you're working with is not going to sell or distribute that mortgage to Fannie Mae, Freddie Mac. It's not going to be insured by them, what have you, and it's literally financed and insured just by that particular bank or lender. Okay, that's what's called a non-QM mortgage. And presently, in the non-QM space, there already exists a 40-year mortgage that was rolled out, I believe, sometime last year. Now, I've never done a 40-year mortgage. One of the reasons that it doesn't entertain me in the slightest, among other things, is that, again, it does not follow the qualifying criteria of and provide the benefits to the consumer of lower down payment, flexible qualifying options, things like that, okay? Anytime you get into the non-QM space or the more portfolio lending space, there's generally a significantly higher down payment requirement, things like that. So yeah, just a little pro tip. Again, there already is a 40-year mortgage. It is in what's called the non-QM space because, again, remember, like we just talked about, per the Dodd-Frank Act, in our qualified mortgage QM world where you have to meet certain criteria, you cannot have longer than a 30-year mortgage, okay? So that would be the first thing. So in order to see a 50-year mortgage, you would have to see some major reform through that Dodd-Frank Act that, again, was passed in 2010. So huge. Make sure, obviously, the people that are, you're talking to about these 50-year mortgages that, if they're talking intelligently about that, that would be one of the very first things that you would want to make sure that they're familiar with, the Dodd-Frank Act and qualified mortgages. Now, what else? Why would a 50-year mortgage be exciting to or interesting to a home buyer? Okay. So presently, and over this last few years since post-COVID time, when of course interest rates have shot up, right, affordability has become a really, really, really hot topic for many, not just first-time home buyers, but many home buyers across the country, okay? When you see interest rates, right, so to give you guys a little bit of transparency, right, I was originally in the mortgage and real estate industry in the early 2000s, 2004 to 2000 and 2007, 2004 to 2007. But when I came back to the mortgage world in 2016 is when I got my current active Nevada mortgage loan originator license. Okay, so December of 2016. So we're coming up on almost 10 years now, okay, since I've been back active in the mortgage and real estate industry. Now, that time since I came back in 2016 until right before COVID, we saw interest rates for conventional loans floating somewhere in the 5%-ish range, and on the FHA side of things in the mid to high 4s. Okay, that's kind of like where your average interest rate was over that period of time, and general affordability kind of latched onto that with, that was relatively consistent. Now, in COVID times, obviously, with a global pandemic and essentially meltdown of the world financial kind of everything going on, we flipped to a 0% Fed funds rate, which of course pushed mortgage interest rates down. Okay, so now we have 2 or 3% interest rates. We have people that previously did not qualify for home loans now did qualify for home loans because of the lower interest rate, more affordability. Now that only lasted so long because of not just going through the home buying process during that time with that decrease in interest rate, right? Did you have a lot more demand? So although you could, in theory, qualify for, right, on paper, you weren't actually getting offers accepted because of people offering above asking, people offering cash deals, people offering with no contingencies, et cetera, et cetera. So that was the piece for most first-time homebuyers or young qualifiers at the time that made it very, very difficult. Much like myself, my wife and I bought our home in 2021, and I own a mortgage company, so imagine that. Now, as interest rates increased, right, as they started to not just creep up, but in 2022, they spiked to, going from 2 or 3% to 5 to 6% very, very quickly, okay? The summer of 2023 to 2024, we saw interest rates start peaking in that high 7 to 8% range, okay? Now, this really, really, really started eating at the affordability for most home buyers across the country, right? Again, it did not matter whether you are buying your next house, which most people that already owned a home with a 2 or 3% interest rate because they were refinanced to the low interest rates in 2020 and 21, they are essentially stuck with what's called the golden handcuffs, okay? Do they want to move? Yeah, they would like to. They'd like to, upsize, downsize. They'd like to relocate, whatever. But is it financially, does it make financial sense for them to leave that 2 or 3% interest rate and mortgage attached to that house for what would be a 6, 7, maybe 8% interest rate on a new house? Unless there is a specific life circumstance or emergency, probably not, okay? On the flip side of that, imagine you're a first-time home buyer that for the very first time, you're trying to purchase your home with a 6, 7, or 8% possibly interest rate, okay? And we've helped many first-time home buyers over the last few years purchase homes in this environment and climate. But what does that mean? It means you need to be substantially more well-qualified. It means you need to be more financially set up for success in regard to your income, employment, assets, credit, debt, etc. And you really need to have a game plan for, most first-time home buyers are, of course, using a 30-year fixed-rate mortgage. What does that look like as rates start coming down? What is the game plan and strategy for things like mortgage refinancing? How long do we plan on being in that home? What does a cost-benefit analysis and break-even analysis look like on getting you into that home and becoming a homeowner, okay? So affordability has just been the hottest of topics when it comes to the mortgage and real estate space for a very long time now. So the 50-year mortgage, here comes the 50-year mortgage, right? It's another conversation starter for the, easing of what is current policy, right? With, again, mortgage terms, rates, whatever. Do I think the 50-year mortgage thing, right, if it does in fact become a thing, because again, like we talked about here in the beginning of the stream, there's a whole lot of reform that would have to happen to make a 50-year mortgage for your average qualifier, right? So if you're going to get a 50-year mortgage, you would like to have it ideally with an FHA or a conventional loan, clearly. That way, hopefully you can put down 3% down, 3.5% down, 5% down, some sort of low down payment option, which is only available for the most part on a government-sponsored enterprise loan. Fannie Mae, Freddie Mac, FHA, etc. Okay. But 50-year term, yeah, it'll on a $400,000 house save you a few $100 a month in payment. But what does it do for the actual economics as it's structured inside of that mortgage loan for the full term of the loan? Okay. So something we're going to really dig into here, talk about, and kind of go through some of the details of. But if you guys are here, again, I really appreciate you guys being here on the live. I don't do these lives for, again, essentially a live audience. I like to make these videos, these recordings to educate our communities, to post on, of course, YouTube, TikTok, Instagram, Facebook, social media platforms. That way we can continue to pour, educational content from an industry expert into, this crazy world that we live in. But if you are here on the live, I greatly appreciate it. If you have any questions, shoot me the questions in the chat. I'd love to answer them live on stream here. But okay, so let me real quick here. Let me see if I can start sharing my screen a bit with y'all. Just give me one moment. Okay, share screen. Nope. Okay. There we go. So let's take a look at what a $400,000 house. Okay. Now we're going to do this exercise just real quick on a just general average FHA purchase. Okay. This is going to be, now remember too, FHA loans are not specific to and only available to first-time homebuyers. They are for the purchase of your primary residence. Okay. You have to be purchasing for a primary residence. You're going to live in that home, ideally for the next 12 months, and you have to occupy that home within 60 days of closing. So we're going to take a look at an FHA loan. Now, just for conversation reasons, guys, I'm going to use the same interest rate on a 30-year loan and a 50-year loan, okay? But I feel like this is not something that I've heard talked about on many channels because most people just don't understand that this is how mortgage loans work, okay? Anytime a lender is allowing you to increase the term of the loan, okay? So let's say, for example, you're gonna go from a 15-year mortgage to a 30-year mortgage, okay? Most of our, especially first-time homebuyers, they're doing 30-year mortgages for affordability, right? But those 30-year mortgages have an interest rate that's slightly higher than a 15-year loan, okay? The mortgage lender is going to incentivize that borrower that's qualifying for that shorter term loan with a lower interest rate, a decreased interest rate. So much in the way from the 15-year to 30-year, okay, you could imagine just by historical evidence that the new 50-year loan, if and when that proposal becomes reality, okay, will also have a higher interest rate, right? So going from 30-year to 50-year in theory should have a higher interest rate as well, because that lender is allowing you to borrow for a significantly longer time, stretch affordability, which will then cut into that, right? When we take a look at the savings proposition here, would cut into that savings proposition, okay? But just for conversation reasons and simply because basically everyone else that is doing the example of 30-year to 50-year is doing the same interest rate, we'll do that for the sake of this conversation. But just understand, again, most times, anytime we have an increased duration in loan term, it's going to come with a higher interest rate. For example, just so you guys can see presently right now, if you see my screen right here, this is Mortgage News Daily. If you guys are not using Mortgage News Daily, it's a great website to track just average interest rate across all top 500 lenders across the country. If you had a 780 FICO and you're putting 25% down. So again, just full disclosure there, you can kind of dig into that. But this is what present interest rates look like for your traditional loan products. So right here, you can see on a 30-year fixed rate, presently today in the market, you would be paying a 6.29% rate, as evidenced by this particular housing survey from Mortgage News Daily. You'll see here a 15-year fixed mortgage, okay, would give you a 5.8% rate. So you're talking about nearly 0.5% in rate difference for the person that's going to be borrowing for half as much time. Does that make sense? So just keep that in mind that anytime generally anytime that you're increasing the term of a loan, you're also increasing the rate associated to it. But let's dig in here a little bit. Let's take a look at a $400,000 house with a 3.5% down payment, which essentially would leave you with a mortgage amount of $386,000. Now, you would have an interest rate presently right now in this market. Let's use the 30-year FHA. Let's use Mortgage News Daily's 6% rate. On a FHA loan where you're only putting 3.5% down, you're going to have a PMI factor, private mortgage insurance factor, of 0.55%. And then we're not going to include taxes, insurance, HOA, things like that in this calculation. But remember, of course, especially on an FHA loan, right? Property taxes, homeowners insurance, things like that are always included in your monthly mortgage payment. Now, they're not interest bearing, so they don't matter as far as this particular conversation, but just as a pro tip, just don't forget that. So let's calculate what this might look like, okay, on a $400,000 house with 3.5% down at a 6% interest rate. This is what your average mortgage payments presently would look like for principal and interest, okay? You're going to see here that total monthly payment of $2,491.18. Okay, so for just shy of about $2,500 a month for principal, interest, and PMI, you too can own a $400,000 house with only 3.5% down. Now, this is kind of a breakdown. By the way, this is the siennamortgage.com website, our mortgage calculator, that if you go to free tools, you can do this from any device. You can do this from a PC and any web-enabled device, so phone, tablet, whatever. Go down to payment calculator. You can use the same payment calculator. On here, underneath the total monthly payment estimate for principal, interest, and PMI of just shy of $2,500, you can see here the total amount of all payments, okay, for your principal, interest, PMI would total $869,249.99 over the life of the loan if you kept the same mortgage loan for the full 30-year term, okay? So let's let that marinate for just a second. Obviously, that is a lot of money, and clearly you're paying about twice as much as that house for the house, okay, over the life of the loan if you keep the same 30-year fixed rate mortgage. Now, there's a whole conversation to be had as far as home ownership and all of that stuff and whatever, but I will always stand behind the power of home ownership, which is evidence-based by a ton of many decades of historical data that home ownership is your fastest, number one, and for most low income, middle income, or high middle income households, they're key to financial freedom and wealth. Just FYI, it's done through home ownership and real estate. Plenty of data to back that up. I don't need to sell that to you. So it is what it is when it comes to home ownership on the total amount of payment that you would pay on a mortgage loan if you kept it for the life of the loan. Now, do most homeowners keep the same mortgage loan for the full term of whether that's 15 years, 30 years, etc.? No. Normally, the average mortgage loan is kept for, now personally, I generally see it from 5 to 7 years on average, right? And I would say that would be pushing it in a market where, again, you're generally going to have different refinance opportunities present themselves to you if you're working with the right people that are, looking out for your best interest. Now, 7 to 10 years, I believe, is the historical evidence, data-driven, of that person either staying in that home or refinancing to a new mortgage. So on average, every 7 to 10 years, someone's either selling a house or refinancing to a new mortgage loan, okay? But again, just for the context of this conversation, we're gonna say that you're keeping that same mortgage loan that you start with for 30 years. So again, you would have, over the life of the loan, paid $869,249.99 in total payments. Now, I feel like this is the part that's super important for people to understand when they're choosing to borrow or being given an opportunity to borrow hundreds of thousands of dollars, especially with a very low down payment, which is fantastic. Because remember, although you have a mortgage on that house and a note, okay, the mortgage lender is going to secure a note to that property saying you owe them X amount of dollars for X amount of time. And if you don't pay them, they are going to come back and try to get that money from you somehow, i.e. foreclosing on your house. But you are still the owner of that property through another financial instrument called a deed of trust, okay? So the county that you live in only cares about who is the recognized owner of that property. And when you become a homeowner, that is you. It's not the mortgage lender. It's not the bank. It is you. So just remember that, right? You're being given an opportunity to actually become the owner of a property that, in this exact example, right? You're purchasing a $400,000 piece of property and you're only putting 3.5% down, okay? So you're only contributing 14 grand to leverage $400,000 of real estate, okay? Now, this right here is what's called an amortization schedule, okay? A lot of people, especially definitely in the real estate side, but even in the mortgage space, they tend to shy away from what's called an amortization schedule because they don't want you to see, or they don't want to have to talk about how much interest you're actually paying over the life of the loan. And more importantly, how much interest you're paying in the beginning stages of your loan. If you were not aware, an amortization schedule generally works in favor of the lender, okay, in the fact that you're paying heavy interest in the beginning of the loan. Now, why do you think that? Okay, why would that be? Because like we just talked about here not more than 5 minutes ago, the average consumer, okay, is selling or refinancing out of that existing mortgage in year 7 to 10, okay? So this amortization schedule is built off 2020, so we're actually in the past year. But let's say we go 7 to 10 years, so we're kind of like right here in this range. Look how little, so the light pink right here would be interest that you're paying. The dark purple is principal that you're paying. And then, of course, the orange right here is the PMI that you'd be paying on that mortgage loan, okay? You are paying, for the most part, primarily interest for the first, in this exact example, on a 30-year mortgage. It doesn't start to flip-flop, okay, until about year 21, okay? So in year 21, essentially, you're starting to pay more principal than interest, okay? This is kind of that cross point on the graph right here. So what do you think happens when we make that a 50-year mortgage, if you had to guess, right? If you had to guess what happens to the amortization schedule and your ownership position, your equity position in that house in a 50-year term. Well, if you guessed that it's going to be a much longer ride and road to actually having equity in the property just based on the amortization schedule. Now, another piece that I'm not talking about, because again, it's a whole nother part of the conversation and of the equity conversation, is home appreciation. So I talk about home appreciation and educate on home appreciation, what exactly that is, specifically here in Southern Nevada, where we're located, where my company's located, because home appreciation is something, again, backed by historical data and evidence that we can show over the last however many decades. This is historical data for home appreciation, which means, does your value of your home go up? Now, not every place in the country has the same historical data to back home appreciation, okay? It's different everywhere. All real estate is local. So we're not going to talk about appreciation, but just remember that's another factor in and another variable when you're calculating your equity position in your house, okay? But real quick, let's punch in some numbers here for a 50-year mortgage. Now remember, on the 30-year FHA loan, we're paying almost $870,000 in total payments over the life of the loan, 30-year fixed rate mortgage, okay? Now, like I said, we are going to keep the same rate here, but based on how other government-sponsored enterprises work and other with Fannie Mae, Freddie Mac, FHA, VA, etc., anytime you have a shorter-term loan going to a longer-term loan, rate will increase. So just mark my words. Expect, if there ever is a 50-year mortgage and they are able to rework and reform the Dodd-Frank Act and they are able to introduce that into our traditional qualifying mortgage world, expect the 50-year mortgage to have a slightly higher rate, okay? But anyways, we're going to use the same rate here. We're going to change the term to 50 years, okay? We are going to now, I have not changed a single thing other than just the term, the amortization period, okay? We are now going to change and hit this button where it says calculate mortgage and see what this number right here totals out to. Bang. We'll see right here. We now have a new 50-year mortgage, okay, where the total amount of payments has now increased on this particular house. Same exact house, same price point, same exact down payment, $14,000, same exact interest rate, 6%, PMI obviously the same. You are now making a total amount of payment of $1.284 million, okay? So essentially it's another $400,000 house that you're paying off over the life of that loan. Let's let that sink in, guys. Let's let that sink in real quick. Get a sip of my Diet Coke real quick. So very important to understand that now, okay, that axis that we were talking about, that cross where you're now paying more principal than you are interest, your equity position starting to grow, et cetera, or grow more rapidly, now happens in year 39 on that 50-year mortgage, okay? So it's basically another 15 years or so of, sitting in a position of I'm paying more interest than I am principal, okay? Now remember, obviously, right, you want to have a game plan for any mortgage when you're in that mortgage. You want to understand, what does it mean as, making additional payments? What does it mean making more payment towards principal? Things like that obviously will dramatically help. We are having a conversation around you just making the minimum monthly mortgage payment every single year, and in this case for 50 years. Total amount you would have paid, $1.284 million. And the actual cross here on our graph, the amortization schedule, is in year 59, okay? So just the additional increase in the amount of house that you're now paying for on a 50-year mortgage is eye-opening to say the least. But again, this is the part that with our clients, with our consumers, with the people that we're educating to empower them. Okay, I want to empower somebody to become a homeowner. I want to make them a homeowner as strategically as possible, as financially affordable as possible, and have them understand and be educated on all of the nuance of what does that house mean for them when they're in that house for, call it, I don't know, 15 years without really making any significant dent in their actual principal owed on the house, because the vast majority of their mortgage payment is going towards interest every single year for the first 20, 30 something years on a 50-year mortgage. It changes things, guys. It changes the conversation of home ownership in general. It changes the conversation of refinance eligibility. It changes the conversation of equity building, wealth building, all of the above. So I wanted to have, this on the screen with examples, have that conversation around first, just of course, kind of the dynamics of a 50-year mortgage and what has to happen for that to be a thing in our current regular traditional qualified mortgage world. And then what does that look like for the average consumer? So pretty crazy. Yeah, I don't know. It's something that, hold on one second. I don't know what, stop sharing. There we go. Boom. It's something that you definitely want to be aware of, and make sure that you're talking to experts and, people that truly have your back and help educate you on some of these topics, because the news will get you. The news would have you believe that we are going to have a 50-year mortgage here rolled out very soon. And that leads me to my next topic. Okay. This is another really good one, guys, and I'm, of course, going over time here. I'm trying to get these done in less than 30 minutes every Wednesday, if possible. Also, if you are here or you're watching this video, we are going to be going live every single Wednesday. I'm now committing to every Wednesday, 52 weeks out of the year, unless there's an absolute emergency and I have to reschedule it. Every Wednesday, ideally at 11 a.m., we are going live for at least 30 minutes, okay? That's my way to talk to you. I am rolling out a big campaign for One to Many in the new year, and I very much enjoy actually going live and doing speaking and workshops and all of the above. So I'm committing to you guys, especially here in the new year, going live every Wednesday around 11 a.m. Shoot me a message, DM me, comment on this video if that sounds good to you. Now, lastly, let's talk about this is an even better one, I feel like. The conversation around Fannie Mae and Freddie Mac no longer requiring, a minimum FICO score for in our world. Okay, so in the mortgage world, we do something, or the very best lenders, and anytime they're doing a mortgage pre-approval, they should be running your clients, okay, so you're a first-time home buyer, you're a relocation client, you're whatever, through something called automated underwriting, okay? Automated underwriting with Fannie Mae and Freddie Mac, okay, these are your conventional government-sponsored enterprises. They have previously, or forever, had a minimum qualifying FICO score requirement, okay? Not the only requirement, but it's been a non-negotiable with a conventional loan, historically, that you cannot have a FICO score below 620 to qualify for a conventional loan, okay? That was a minimum qualifying ability to repay requirement. And now it looks like that minimum qualifying FICO requirement is going to be lifted, or I don't know if it has been lifted or it's in talks to be lifted, from Fannie Mae and Freddie Mac. Now, does that mean that anyone with a qualifying FICO score under 620 is now going to qualify for a conventional mortgage? No, obviously not. There's still all of the other qualifying requirements and criteria that you're going to have to meet. That's income, that's employment, that's assets, that's credit, that's debt, that's property, all of the other minimum qualifying metrics that, again, if you have all of those other things and they're in perfect shape, which they likely aren't if you have a sub 620 FICO score, but let's say, for example, you have a 585, 590 FICO score, could you, in theory, now qualify for a conventional mortgage? Maybe, but I still feel like it would be highly unlikely, because this automated underwriting system that we use in the mortgage world to, of course, underwrite to ability to repay requirements and all of the above, it's still sticky. It's still, and again, we want it that way, guys. We want there to be a barrier of entry for people to own homes. That sounds crazy, but I promise you, we do not want, there cannot be an ability to open the floodgates and let every single person walking the streets without an ability to qualify or repay that mortgage, qualify for a mortgage. Just can't have that. That's why we have certain thresholds and levies there to protect our real estate environment. Okay. Now, if they lift the 620 FICO, does that start or open new conversations for those borrowers that may otherwise have lower FICO scores presently? Yes, absolutely. That probably starts a ton of new conversations, probably gets, a lot of the general public more excited of, okay, there isn't this specific barrier of entry that I know I definitely can't surpass or, get over in the very beginning with a little bit of help here and there. But just remember, guys, just kind of understanding how to educate the community, your clients, your partners, how to navigate these conversations before you say something that you can't take back. Just understand that somebody that has a sub 620 FICO and there's no longer a minimum 620 FICO requirement from Fannie Mae, Freddie Mac doesn't mean they automatically qualify, obviously. Now, in addition to that, in addition to the other income, employment, asset, credit, debt, property requirements when it comes to qualifying for a mortgage loan, you also have mortgage lenders. Okay, so remember, guys, Fannie Mae and Freddie Mac, they're not a mortgage lender. Okay, they insure mortgages. Okay, they are essentially the secondary market that buys these mortgages and sells them to Wall Street. Okay, it's their requirements that we underwrite to, and when I say we, I mean mortgage lenders. Okay, at the end of the day, though, it's still mortgage lenders' money. Okay, that's being given to the borrower. Okay, they're lending their money to you, and then those mortgage lenders also have their own requirements. Okay, in the mortgage world, we call these overlays, and those overlays can be specifically from the lender, and a lot of times they take precedent on, okay, obviously we have Fannie Mae, Freddie Mac guidelines that we have to follow for traditional just mortgage underwriting guidelines. But this particular lender, they don't want to do a mortgage loan for a sub 640 FICO. They don't have any programs available to it. They don't underwrite to it. That's their specific overlay. They're going to require, okay, specific whatever. Okay, they can have what they call lender overlays. Okay, this is very different lender to lender, and that's why working with a mortgage broker that has access to many different wholesale lenders across the country allows more opportunity to these home buyers when there's optionality, okay, and which lenders fit your qualifying scenario best. But just remember, it's not up to only Fannie Mae and Freddie Mac, okay, because it's also a lender that you have in the middle there that has their own overlays. So 620 FICO, is it a good idea? 620 FICO, minimum FICO removal, is that a good idea? It starts more conversations. It's definitely something that is buzzworthy in the industry, and it'll have some people excited to try again. Now, does it mean that people with sub 620 FICO scores are going to be qualifying left and right for mortgage loans? And are they going to be, are we going to have a flood of people now? No, guys. Also, I don't know exactly what the data is. I'd love to pull it up. I don't want to write this very second on stream again. But what the data is with the average qualifying FICO score for your average consumer in today's real estate market. But I want to say it's gotta be somewhere in the 700 range, okay? Our average FICO score for the general consumer presently, now this might be a little bit different, especially where housing finance is a little strained presently right now in our economy, credit card debt stacking up, car payments, whatever. But look, average FICO score is pretty high. You know what I mean? It's a lot different than it used to be in the early 2000s, the late 90s. And again, I can only speak to that because I grew up in this mortgage industry as basically my entire life. And I remember FICO scores being substantially lower in the late 90s and early 2000s, okay? I don't know if it was credit mix or credit utilization or people just understanding and being educated more on credits, but our FICO scores are generally much stronger now. So is it going to affect a vast amount of the population. I don't know. But it's a great conversation starter, guys. If you are watching this and you're a real estate agent, you're a partner, you're somebody in the real estate world trying to start these conversations, get people excited about home ownership, and kind of get the ball moving forward with your community. It's a great talking point, but just educate yourself. Make sure you understand all the nuance to these things. Just because it's buzzworthy in the media or in the news, protect yourself. What I like to say, CYA, because once you say it, can't take it back. Okay, you don't want to set the wrong expectations with your client in the community. Guys, it's always a pleasure. Again, like I said, I'm going to be committing to these lives every single Wednesday, ideally around the 11 a.m. start time. If you are here with me, please comment on this video, give it a like, a heart, a thumbs up, whatever you can do to show your support. Mario with Sienna Mortgage, your local mortgage experts. Who you partner with matters. And guys, remember, teamwork makes the dream work. Have a wonderful day, guys. Take care.